Getting off to a good start, being laser focused is wildly important for every professional investor. And a lot of people will have taken down risk in the last 3 weeks of the year. They want to lock in their year. They're going to do their tax loss selling. They want to make sure they don't lose that incentive fee that they've already spent on their wife's diamond earrings for Christmas, whatever that situation is. And so you come back and you're like, oh, I got to get back in the game, baby. And people put on a lot of risks the first few days of the year. You often see the existing trends accelerate. And then 3 weeks, 4 weeks, 5 weeks later, there's a correction because everyone kind of gets into the same mindset.
As 2026 approaches, Bitcoin is no longer framed as a speculative gamble. It's increasingly viewed as a strategic asset entering a new phase of maturity. The conversation has shifted from if Bitcoin will rise to how the trend unfolds, as adoption, regulation clarity, and institutional positioning align. The start of the year sets the tone, and history suggests momentum favors those who position early. Bitcoin's price trend in 2026 is expected to reflect continuation rather than chaos. Following prior cycle behavior, capital typically re-enters the market with confidence after year-end repositioning. Fund managers, corporations, and long-term holders look for clean exposure as portfolios reset, reinforcing upward pressure without the frantic excess of earlier cycles. This creates a steadier climb, higher highs supported by conviction rather than hype. What makes 2026 different is structure. Spot ETFs, sovereign interest, and growing balance sheet adoption reduce volatility while strengthening demand. Bitcoin's limited supply meets expanding institutional access, forming a powerful price foundation. Instead of sharp spikes and collapses, the market increasingly favors sustained trends and disciplined accumulation. Price targets naturally become bolder in this environment. Six-figure Bitcoin is no longer a headline, it's a baseline discussion. Whether the market consolidates above prior cycle highs or pushes toward new discovery zones, the direction remains clear, upward, supported, and increasingly resilient. In 2026, Bitcoin's trend isn't about proving believers right. It's about confirming that Bitcoin has become a permanent pillar of the global financial system. Before we continue, please support us by smashing the like and subscribe buttons. Remember to turn on your notification bell so you don't miss out on our latest content. Thanks for joining us again. Let's watch clips from Michael Novogratz as he talks about Bitcoin's wider bullish run with Anthony Scaramucci.
The first 2 weeks of the year are super important. So why is that? And you say people come out of the gates hard. Tell us what you mean.
Even though maybe it shouldn't be this way, many people, almost everyone in investing, are graded year to year. How you do this year? I'm up 16%. I can't believe I'm only up 4%. Oh, I'm getting crushed. I'm down 27%. And we have this annual cycle where, start fresh. Now listen, if you had a year where you made 38% and you get paid some incentive fee, let's say you're a hedge fund, you get paid 20% of that, you take that fee. Hey, if you're gone from 38% to 30%, that's not the end of the world. But when you start at zero, if you instantly go down to 8%, oh, that would really suck. And so getting off to a good start, being laser focused is wildly important for every professional investor. And a lot of people will have taken down risk in the last 3 weeks of the year. They want to lock in their year. They're going to do their tax loss selling. They want to make sure they don't lose that incentive fee that they've already spent on their wife's diamond earrings for Christmas, whatever that situation is. And so you come back and you're like, oh, I got to get back in the game, baby. And people put on a lot of risks the first few days of the year. You often see the existing trends accelerate. And then 3 weeks, 4 weeks, 5 weeks later, there's a correction because everyone kind of gets into the same mindset. And so you're crazy if you're a professional trader not to be in your seat Jan 1. You don't have to trade, but the first day, whatever the first, if Jan 3, Jan 4, whatever the first trading day is, you got to be in your seat and you got to be focused.
Go look at Google and look at conversations related to Bitcoin, searches related to Bitcoin near all-time lows, Mike. Okay, so that makes me positive too. Am I wrong in thinking that way?
So listen, I'm not thinking that different than you. I think we're going to get a new Fed governor who's going to be dovish, and the Fed's going to cut And what does that mean? It means to me the dollar sells off. To some degree, I think the easiest trade is probably staying long the Aussie dollar, the euro. Euro goes from 118 to 130 over the course of a year. And so we have the next leg down of the dollar. That would be one of my trades. Gold and silver have had such monster moves. I'm preparing for a reversal at one point. If you're not in them, it's hard to be in them here, though. You can buy gold with the tight stuff under the old highs, which I did today. But I think you wait to reset gold and silver for a major correction. You always get a correction, right? One of the great tricks in trending markets is you buy pullbacks to the 50-day moving average. So that's the average price over the 50 days. Markets always correct there at one point. And so you don't have to pay the highs of everything. I think crypto has been such an underperformer. It's got the same story as gold, and it hasn't been gold at all this year, that there's a real fear. I think the painful trade is crypto higher, not lower, for all the professional community. So if it gets moving, it could really accelerate. It's got all the ingredients of getting moving, other than it's not moving yet. And so I'm watching it really carefully. I don't want to be pessimistic down here. I need to see it start gaining momentum and break 100, and then I would get really excited. But I think crypto could be a good 2026. Stocks are be interesting, right? Again, the Fed's going to be cutting. You still have this AI story. Things like Google and Microsoft and Facebook, Meta aren't as expensive as they were last year because their earnings are growing so quickly. Next year's trades feel a little bit like this year's trades. That's always a little scary, but that's kind of, I think, what the fundamentals and the technicals say your portfolio should be. Again, because things are extended, you got to be careful. You got to pick your spots, right? You don't have to always be invested. You want to be invested from good levels. I think the data center business has legs. I think there's a demand for power that's not going away next year or the following year, or quite frankly, the following year. As we get further out, it's harder to predict, but I think there's a good runway left. We constantly are in conversations with, people that use power. And let me tell you, there's demand for power. And so I think that's going to be the bulwark of our valuation. I think there's just so much optionality. A, that crypto prices go higher, but B, that crypto as an industry is going to become more relevant and important because we're going to tokenize real world assets. They're going to, over the next 18 months, the blending of TradeFi and crypto happens. And we're going to try to make sure Galaxy is a part of that future. We have a really strong brand. We have a lot of strong relationships with institutional people. And it's our challenge and our job is to turn those into, financially lucrative businesses. And so this has been a challenging year in terms of a lot of progress on the building. Prices of crypto are down on the year. But I think in next year we might have choppiness. I think Bitcoin prices are going to go higher, but I'm sure the activity around building infrastructure is going to accelerate. The data center business, is probably equally important or even a little bigger from a market cap perspective than the crypto business. And it could get substantially so. And so we get asked all the time, will we split them in two at one point? We'll take it as it goes. Right now we're one business. I certainly could see a world in 12 months where there are two businesses because they have different cycles and different capital needs. The crypto business itself, I think, is at least 3 to 4 years away from not being impacted by crypto prices. And that's because all the revenue in the asset management business, in the staking business, in the trading businesses is some percentage of the underlying asset. And the asset's not in dollars, it's in Bitcoin. So if Bitcoin price falls 30%, your revenue goes 30% off it. Especially in the proof of work where you make a lot in staking. If it's staking Solana or staking something else, price goes down, you make less staking. And so we're just too correlated still to price, even if we held no crypto on our balance sheet, which we do. And so we're a few years away from that. But I think as a whole, even this year, we've been less correlated to price of crypto because of the data center.
The first 10 trading days and 2 weeks of the year carry huge weight for investors. Performance gets measured year to year, up 16% or down 27%, so resetting to zero ramps up the stakes. A hedge fund manager who earned 38% last year and took a 20% incentive fee can afford a dip to 30%, but starting at zero and falling to -8% stings. Pros stay razor-sharp early. They trim risk in late December for tax loss selling and to secure bonuses, then reload aggressively in January, speeding up trends before a correction 3 to 5 weeks in. Be at your desk on the first trading day. Low Bitcoin search interest signals bullish potential. A dovish new Fed chair and rate cuts could weaken the dollar, favoring longs like the Aussie or Euro. Wait for gold and silver to pull back to the 50-day moving average. Crypto lags, but could surge past $100,000 with momentum. AI fuels stocks like Google, Microsoft, and Meta as earnings drop valuations. Galaxy's data centers tap endless power demand, matching or exceeding crypto's market cap value, while tokenization and TradFi integration build relevance, less tied to Bitcoin prices now.
But I want you to explain staking to our younger people that may not understand what staking is.
All right, sure. So this is going to be a simplistic description first of blockchains. So what blockchains are, right? Bitcoin was the first blockchain we heard about, are big databases that instead of being owned by one person, where the one person puts all the inputs in, they are kept up by a community where different communities put the same data in, look at the data, and then validate that, yes, that's the right data. And then they put a big stamp of approval on it. That stamp of approval in Bitcoin, which is a proof of work blockchain, comes from the Bitcoin miners. They mine a new block every 10 minutes. That block gets mined. It stamps that spreadsheet to become permanent. And then the next 10 minutes, a new spreadsheet gets a new stamp with new data gets put on top. And so it's almost impossible to change the old one because there's one on top and then one on top and then one on top. And so when people talk about the immutability of a blockchain, it's the immutability of a database. I can't change the data. Proof of stake, which is the other way people validate the data on that spreadsheet, on that theoretical database, came up, one, because it would be cheaper, it would use less energy. It's used in Ethereum, it's used in Solana. But you have validators who validate what's on that blockchain, and they get staking rewards to do so. Those staking rewards are the payment for running these big computer systems, and they're also the inflation level of that underlying ecosystem. So if it's Solana at 6.5%, 7%, that means there's 6.5%, 7% new tokens made each year. So that's would be inflation. There's a debate, should that come up or down? And so those are really the two different ways crypto ecosystems ensure that the data that's put on blockchains is inviolable.
Okay, well, follow-up question to that. A lot of people ask me this, so I'm going to ask you it. Is that staking inflationary? Does it hurt the overall weighted average of the market capitalization of the token?
Well, it certainly is inflationary relative to zero. Is it inflationary relative to the dollar? Well, if the dollar's got a high inflation level, no, right? But right now you've got 7% new tokens being made in Solana every year. And so that's inflation. Now, you can still see a wild appreciation if the growth rate of activity is higher than 7%, right? Ethereum, that level's come way, way down. Bitcoin had its own version of inflation, just how big the mining rewards are, and they have it every 4 years, it gets cut in half. And so it's becoming de minimis. But yes, it is inflationary. I need 7% to break even with my purchasing power.
So start with the yen carry trade and then give us a prediction directionally, given what's going on with rates in Japan, where that holds out for 2026?
So traditionally, because Japanese economy was so weak, they were not producing people, right? They were high savers. They had the lowest interest rates in the world for a long time. And so you could borrow in yen at roughly zero or even negative for a while, and you could lend in other currencies, Brazil at 14% at one point. So you would go long Brazil and short yen, or long the dollar and short yen. And even if the rate didn't change over a year, you'd make 5%, but often you would have dollar yen weakening. So this year, dollar yen has weakened a lot. We're 156-ish. Let's say today we are, 157. I'm sorry. Even though the dollar is weakening, it's not weakening against the yen. It's strengthening against the yen as people are leaving the yen and moving their money outside. What's getting nerve-wracking is as it's happening, you're seeing Japanese long end, because inflation is picking up in Japan. The long end rates have went from basically 10 basis points in 10 years all the way to 2%. So the single largest move in Japanese long end rates that we've seen in years, 15 years, that's maybe the canary in the coal mine, which might happen in places like the US, right? And so now Japan is making, do we need to raise rates to stop capital from leaving our country? They have a huge amount of reserves, and they probably have 200 billion that they can sell against the dollar to intervene to keep dollar yen from going higher. But if you look at the chart and you look at the story, it won't surprise me to see dollar yen at 200 by the end of next year. And so the single best currency trade this year that you could have had on was short the yen and long the Mexican peso, right? Mexico's got a really good president in Mrs. Sheinbaum. They've got a lot of good things happening there, connecting close to the U.S. economy. And, the onshoring out of China is Mexico gets some benefit of that. I'm sorry, the offshoring from China. So Mexico versus yen went 20% plus the carry, right? Which was probably another 7% or 6%. And so that probably carries on.
So good for Bitcoin?
The Bitcoin story is global liquidity. And so if Japan decides, oh no, we need to start buying our bonds again, we can't afford, we have to monetize this bond thing, it's dangerous because they have inflation. Like this whole monetization works until there's inflation. Trump knocking rates to 2% is possible maybe because right now inflation seems like it's going lower, even though affordability doesn't. And so if you can give me one silver bullet of knowledge, I would want to know what both core PCE, core CPI, and really a survey of 15 Americans in different classes, what's affordability done a year from now? Like that's the $69,000 question. What will all this do to inflation? And if it's a combination of AI and a softer economy and keeps inflation low like this last print, hey, the Fed can push rates lower, the government can spend more money. Like inflation really is the club that will beat senselessly the Fed governor or the Treasury secretary because it just eradicates wealth and spending power from working class, middle class.
Yeah. Michael Novogratz shifted the focus away from technical mechanics and toward what ultimately matters to most investors: price and long-term value. He framed Bitcoin as a system designed for durability, where new blocks are added at a steady, predictable rhythm that makes the network increasingly secure over time. That reliability is what gives markets confidence to assign a higher value as adoption grows. Bitcoin's fixed supply and transparent issuance schedule continue to shape its price trajectory. With fewer new coins entering circulation over time, selling pressure naturally declines while demand expands, from institutions, funds, and even governments seeking neutral, scarce assets. This supply-demand imbalance is central to many 2026 price projections. Novogratz emphasized that price appreciation doesn't require speculation-fueled chaos. As Bitcoin matures, value is increasingly driven by real usage, long-term holding, and macro relevance rather than short-term trading. Each cycle builds on the last, turning previous resistance levels into long-term support. For 2026, the conversation around Bitcoin price has shifted upward. Six-figure levels are no longer framed as extreme optimism, but as logical extensions of Bitcoin's economic design. Whether Bitcoin consolidates well above past highs or moves into new price discovery zones, the underlying trend remains constructive. The key takeaway is simple. Bitcoin's structure favors patience, and by 2026, the market may be pricing that patience at levels few once thought possible. On the yen carry trade, he recalled borrowing cheap yen, near zero or negative, to lend in higher yield currencies like Brazil's 14%, profiting even without rate shifts. This year, the dollar-yen weakened to around 157 as capital fled Japan amid rising inflation and long-end rates jumping from 10 basis points to 2%, the biggest move in 15 years. He predicted dollar-yen could hit 220 by the end of 2026, with Japan possibly intervening via reserves. Short yen against Mexico's peso worked best this year, 20% plus 6 to 7% carry, thanks to Mexico's strong leadership, U.S. ties, and China's offshoring benefits. Bitcoin benefits from global liquidity. AI and a softer economy might keep it low, letting the Fed cut rates and boost spending, but inflation erodes working-class wealth. As we wrap up, do you believe crypto revenue streams like staking and trading will ever fully decouple from Bitcoin's price swings, or will they always move in lockstep? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.